subscribe now and press the bell icon. Never miss an update.
Let's start with concept of basis. This is really important in federal income, state income taxation, because basis is something whenever we talk about capital gain, the first question that comes in the mind is what is the basis of the property? Or when we are talking about doing 1065 returns, LLCs or partnership and all, immediately we kind of first we want to understand what is the basis of the partner in the partnership or the basis of the shareholder in the S corporation. Okay, those things are very much we need to understand what does basis mean, because basis is a very important concept in US taxation. And basis is the measurement of taxpayers' investment in property or business or whatever, but how much the taxpayer has put in. That becomes the basis. If there are adjustments to that, if there are any other transaction which may lead to adjustment to basis, we need to make sure we are doing it correctly, because a lot more transaction would be dependent on what we show up as basis. If you are selling off the property, the capital gain may not be calculated correctly. Right? Because what is capital gain? Capital gain is sale minus cost basis. Yeah, in layman term, we can say that, okay, whatever I bought it for, that becomes cost basis. Correct, perfectly. I mean, yeah, conceptually is really right. But then there might be some adjustment, and we need to be aware of those, that if something like that happens, if those transactions happen, we need to make sure, and we need to make sure to go back and adjust our basis. Otherwise, the capital gain or capital loss that would be computed would not be correct. So let's see, the property basis is used in determining the gain or loss. That's fine, we know that. The basis of an asset is generally its cost, but it may be adjusted over the course of time due to various events. If you're holding a property for 10 years, it's not really whatever you have bought it originally 10 years back. That's just not the basis, because it may have to be altered, as and when certain events have happened in last 10 years. What will impact basis, what will not impact basis, that we need to have a clear understanding of those principles. The basis of property must be increased by capital expenditure and decreased by returns. Right? This is again a very universal rule. It's universally true in every country, every tax regime that we are talking about, that the basis of property must be increased by any further capital expenses. And if we are taking out something from that property, it needs to be reduced. Property doesn't mean that you have to sell everything in one shot. You can also sell some shares of that property or some part of that property. By share, I don't necessarily mean stocks. I can say some portion of that property might be sold. Okay, so that may make it more complicated. How do we split it up? How do we split up the basis? How do we make sure the right, cost is being transferred to the portion which is being sold? Apportionment, that is called. We need to apportion the basis for the whole property or the different units of the property. Okay, so increase in basis have the effect of reducing the amount of gain realized. Obviously, as the cost basis increases, the gains will go down, and decrease in basis will have the effect of increasing the gains, because the cost becomes low. If something we are selling for $100 and we have acquired it for 20, but some events have happened which may make the basis to go down from 20 to 10. If any of those events happen, then our basis becomes 10. Sale price is constant, that's going to be 100, so the gains would be $90. Similarly, the basis, the original basis is $20, some more transaction happened which would increase the basis, like some more capital expenses, you bought a property, you're constructing one more floor on top of it, or few more rooms, it may go from $20 to $40. And then the gains would be 60. So the basis would have a direct impact on the gains, and we need to understand it very thoroughly. So what is the cost basis? This is simple, the sum of capitalized acquisition costs. What is substituted basis? If any property is being substituted by another property. Reference to basis in the other property. Transferred basis. If the property is changing hands, it's being transferred from one person to the other. Exchanged basis. If it's being exchanged for some other property, right? Transfer is something like if one person is giving something to the other person. It could be a gift, it could be inheritance. Exchange, that could be one property is being exchanged for the other property. Then we have to see the reference to the other property which is being exchanged, or what is being received, what is being given. Converted basis. If a property is being converted, let's say it's a personal property, a car. Let's say a car is a personal property, but then you start a business and you say, okay, I'm going to use this car for my business, and you want to convert it into a business property. So what are the rules over there? How do we do the conversion? Right? So that's all we're going to look into. Capitalized acquisition costs, again, this is a simple thing. I think we all have read about it when we did our accounting in our schools or college and all. What cost can be capitalized, what costs need to be expensed. So when we are purchasing the property, any costs which are directly related with the purchase will be capitalized. It could be as simple as notary fees, some government fees, or title acquisition cost, or some other taxes that needs to be paid with the closing cost, any commissions, transfer taxes, any insurance, recording fees, and all those things, document fees, preparation and all, because this is all needed to purchase the property. There can be some other miscellaneous cost, which could be appraisal fee. When you're going and buying a property, sometimes you need an appraiser who would come and say, okay, what is the fair market value? What is the comparative value in that area? I need to get it appraised. And it could be freight or installation cost. Freight, like buying a air conditioner, we want it in the to be delivered to our office or to our property. Then we have to look into what is the freight cost, what is the installation cost, what is other cost that comes with it, packing cost, maybe transportation cost, and all those things. Any new improvements, any major improvements. It could be we are putting new roof, or we are putting new windows and doors, and we need to make sure we are properly differentiating between what is a regular maintenance expense and what is an improvement expense. Regular repairs and maintenance will not go for capitalization. Right? That's an annual cost, or that's maybe once in 2 years we're doing, but then that is not adding life to the property. The demolition cost and all, new electrical wiring, new plumbing that person is doing, on the property and all, that will all go up as major improvements. Expenses not properly chargeable would be any operating and maintaining expenses. Again, these are all very basic accounting principles that we all should know. When we are buying a fixed asset, what goes in the balance sheet as an asset, what will come in the profit and loss as an expense. But we are going through it again in detail so that we just refresh our knowledge on that. Anything which is like an annual maintenance or insurance or ordinary maintenance or repairs, that will be obviously considered to be a regular maintaining expense or operating expense. Okay, so that will not be added to the basis of the property. Let's look into what are the capitalization rules. We'll just go to this part, which I'm skipping in some time. But first, let's look into capitalization rules. The cost for construction of real or tangible property to be used in trade or business or producing or acquiring property can be capitalized. But and all costs necessary to prepare the property for its intended use will also be capitalized. Any construction period interest and taxes that we are paying, we have to capitalize that. Once we get the possession of the property, then every year also we may have to pay mortgage interest and taxes and all, but that doesn't get capitalized. That becomes an ordinary annual expense to maintain the property. The cost basis may also include fair market value of property given up. Sometimes if we are giving up a property and we're getting something in exchange, then we need to see what is the value of the property that we are giving up. Maybe that becomes a cost basis. What is the fair market value? At that point of time, what would be the market value if you have to sell it to someone? But you're not selling it here, you're exchanging it with something else. There's no cash component involved here, but we can always go with the fair market value as long as we can prove, that this was the fair market value. How can we prove it? Maybe by getting some appraisal done, or by looking into some internet-based transaction that has happened in that locality or neighborhood and all, or some any other facts or proof that we can bring, which can help strengthen our case in front of IRS if they question on how did we compute the basis. So usually whatever property we are giving up, we will take the fair market value of that property as the cost basis. But if it is not determinable with reasonable certainty, we can also use fair market value of property received, because this is an exchange. Maybe the person is saying, I have a BMW, I'll give it to you. Can you give me your Mercedes? Yeah, possible. Yeah, so we have to now apply these rules. Any acquisition expenditure and all, obviously we saw that. Any rebate to the purchaser, a lot of times, and rebate is very common. A lot of times when we go and buy, say, a refrigerator or even a car or something, they have some deals going on. They said that, okay, if you're spending $10,000, we'll give you $1,000 back as rebate. There's one thing called discount. The other thing is called rebate. Discount is different. Discount you get right. And maybe you don't have to include discount as a adjustment to the basis, because your net amount that we are paying is post discount only. So we'll obviously go with whatever amount we are paying, net of discounts. But when there is a rebate, what does rebate mean? Can anyone explain me the meaning of rebate? Does anyone know that? Shweta, can you explain? Give it a try. Sorry?
Reduction in the price.
How does it work? I mean, the discount is also reduction of the purchase price. No? So what is the difference then? Anyone else? Raksha?
Discount is like we don't need to pay originally, but rebate is like we have to pay originally, then we get refund in some form.
Exactly. That's what rebate is. And rebate is very common in US. It's probably not as common as it is in India. So what happens when the purchaser goes, they pay full price. After a few days, after a few weeks, they may get a check in their mail saying that, okay, because you bought this, this asset from our store or whatever, you are eligible for this rebate. And rebate usually comes from the manufacturer. It may not be from the retailer or from the shop. Discounts can be put up by the shopkeeper. That, okay, we are having this discount, the sales is going on, some kind of sale, or some like Black Friday off, or Thanksgiving sale, or Christmas sale, Diwali sale, whatever, those things. But rebate is generally given by the manufacturer. That if you are buying our product, then we may give you this much back. So that is obviously it is not included in basis, and also we have to reduce it. So even though we paid $10,000, after a month, say we got $1,000 back, then for a month the basis would be 10,000. When we get it back, we deposit it in our account. The basis has to be reduced by that $1,000. We cannot take that $1,000 as other income or something in our books. We need to make sure we are adjusting our basis with that. And the capitalization rule will not apply if the property is acquired for resale. Obviously, then it is not a capital property, it becomes a kind of inventory. If we know there could be, right, people like, those, all these car dealers, they have a lot of cars, they have hundred of cars for, with them. So for them, it's not a capital asset because it is acquired for resale. But for some other business, a car or a truck could be a capital asset. So we need to see what is again the, what is the use of all that, and we need to see the facts and circumstances before we come up with any rule. That's again very general observation that one needs to do. Again, liabilities. What if you are like assuming some kind of liability when you are acquiring an asset? That needs to be adjusted. So any acquisition basis is increased. Like if you're buying a house and the seller says, okay, fine, I'll, the value of my house is say $100,000. I'll give it to you for 50,000, but I have a loan on that house for 70,000. You also need to take care of that loan. That loan needs to be transferred to you. Then obviously, what will be my basis? 50 I'm giving in cash. I'm assuming liabilities of 70, so it's going to be 120. So we'll just take a, 13.13 will go a bit later. Okay. Divyansh, do you want to read this example 9.1?
If an individual buys a building for $30,000 cash and assume a mortgage of it 190,000, the individual basis is $220,000.
Yeah, can you please explain it?
Um, the building purchase cost is $30,000 and the mortgage will be $190,000. Then the sum of these two will be $220,000 because it
Correct.
will add the mortgage in amount to the purchase value.
Hmm. Correct. So because we are also assuming the liability amount, so the basis would be calculated accordingly. Okay. Let's go over this example now. So basis in a rental house includes purchase price plus closing cost. Add to the basis and capitalize long-term improvements. So in the figure 9.1 above, what they're saying is the right side of the house shows capitalized improvements that must be depreciated over a period of to 27.5 years. Right, let's see right size. What is happening? They're probably doing the landscaping. They've made this, or they're putting a new garage door, camera, and all those things. A new plumbing has been put up. So this all looks like all newly done thing. So what they're saying is this includes improvement to land like sidewalk, landscaping, sprinkler system, swimming pool, new roof, and also that will all go for capitalization. The left side of the house shows short-term repairs. And obviously those are expensed in the year in which they are made. So short-term repairs would include repairing broken windows, faucets, and all. So there is probably some roof is leaking here, so we're getting the repairs done. We're not changing it completely. Here we have put the solar panel, so that becomes a capitalized cost. Some it may need a paint or it may need some woodwork to be done. Again, these are all repairs and maintenance. This is like the painting thing, right? So that is showing that these are all regular repairs and maintenance. So this is how we can it's just a visual, aid to just help understand this concept properly. Okay, let's go to the next point. Any fair market value of the property received in exchange for services, then it becomes an income. If we are providing services and somebody comes and says, okay, well, I don't have any money to pay, but I'll give you stocks. Okay, or the employees get compensated in stocks also. They get RSUs or stock options and all. So that becomes a regular income. It doesn't become. It's not like they will just keep it and they'll not pay taxes on it. As and when it is received, it has to be treated like regular income, and taxes has to be paid on ordinary rates. But obviously, when it gets transferred or when it gets sold out, we need to see what is the capital gain on that or loss on that. So the property acquired has a tax cost basis equal to fair market value of the property. After some time, it could be on the very same day, it could be 6 months later, it could be 10 years later. Whenever you are selling the property, we need to see what was the fair market value as of that day. Because all that fair market value got captured as ordinary income for that person. Is paying taxes on that. Later on, when we are selling the asset, if you don't include the fair market value, okay, you'll go through the bank statement and say, well, this person paid $500. Fine, but we are not considering what was the fair market value. Maybe the fair market value was $1,000. We are just going through the bank statement saying, okay, this person paid $500 to acquire his employer's stock, and fine, and then now this person is selling it for 5,000. Take 500. Okay, less 5,000, 4,500, that is the gain. Is that right? Is that right? Anyone?
No, ma'am.
No, ma'am.
No. Why? Because we are not taking the fair market value. So what is happening by doing this calculation, will end up paying more in taxes. The gains is coming to 4,500, but if we had considered what was the fair market value, we knew it was $1,000. So 1,000 minus 5,000 should give a gain of $4,000. Yeah, so it's very important to put all these things in our notes properly and all, so that the basis is calculated correctly. And the ordinary income that needs to be taxed is also calculated properly. Otherwise, the person may get a notice, and then on top of that, interest, penalties, and all, and it just gets worse. So the basis of a restricted stock is the price paid other than by services. We have to see what is the fair market value. Same thing, we have to see what is the spread between fair market value on that date and any amounts we paid. Okay, that becomes that will become the ordinary income, the difference between these two amounts. And the basis has to be increased by that amount. If you're taking basis as any amounts paid, then we need to increase the basis to bring it up to fair market value. Right? And the transferee may elect to include the fair market value minus the cost and all whenever the stock is purchased. That's that they have to do, because that will be considered as gross income. That is paid because the person has provided services. So it's clearly a gross income for that person. It's an ordinary income. Think about it, like instead of getting paid cash, the employer is saying, well, we don't have so much of cash, but we'll give you stocks. The tax treatment has to be same, whether the person is getting paid in cash or in stocks or in some other way, or some property or some rights they get to some property, whatever it is. With cash, it becomes very easy. By cash, I mean bank transaction as well. But then it becomes very easy because it's very easy to quantify. $5,000 will remain 5,000 only, right? There's no way you can say, oh, $5,000 fair market value is 4,000. It's a very straightforward thing. But when the compensation is made in the form of a property, we always have to make sure we remember these roots. Okay, any questions on this? Otherwise, we'll move to the next topic. I hope we all understand that. Okay, let's go to lump sum purchase. If we are buying more than one asset in a lump sum, but we are selling one or two at a time, then how do we apportion the cost? So again, what they are saying is you take the total fair market value upon total cost based on the relative fair market value. This will be the first approach. The second approach is, if you don't want to do that, fine. The transfer and transferee can have an agreement in writing saying that, okay, this is what we are going to settle down at. Because sometimes The fair market value may not, I mean, it may be different. The transaction may be done at a different price or different amount, given if there is any urgency to do either the transaction. Maybe the seller is really in need of money. The seller is saying, fine, I'm ready to go beyond fair market value, but I need money now. Maybe the purchaser is having some other constraints. So these are all the factors that need to be considered, because these all factors can happen. All these situations can happen between two unrelated parties. So if you are not going for fair market value, it doesn't mean that this is going to be unreasonable transaction, or this is going to be a transaction that will be tempered in order to evade taxes. Sometimes there are more economical reasons. There might be different reasons why the person wants to sell it at a lower cost, or why the person wants to buy it at a higher cost. Maybe the adjacent plot is already bought by the person, and he really wants the plot next to his own one. So maybe he's ready to pay the premium, saying that, okay, I'll have a continuous piece of land. It depends what the necessity of those two people are. So that is also fine. If you don't want to go with fair market value, go with whatever has been agreed in writing, and that will be binding on the parties. But IRS should not deem it to be improper. So it cannot be, if the market price is $100,000, you cannot sell it for, say, like $5,000, $10,000. That is improper. That is unreasonable. There could be 10-15% here and there, but completely throwing off those numbers is IRS may reject it. Even though you may have an agreement in writing, it may be binding on the parties, then it looks like they're cooking something. So we always have to see, will the IRS look it from IRS perspective. If you are IRS officer, what would you think? Would you accept whatever your the taxpayers are doing? Does it look reasonable to you? If it looks reasonable, it's fine. If it doesn't look reasonable, then we need to make sure that it looks reasonable to IRS. So maybe do the transaction on more reasonable numbers. Okay, so it has to be binding on the parties unless the IRS deems it to be improper. And if it's improper, then we have to use the residual method. If IRS says, well, we don't agree with whatever agreement you have in writing, we don't agree with the value that you're putting for your assets, then IRS may go with residual method. What is residual method? We will just see it in a moment. So the reason we need to know all these things, so that we know what are going to be the repercussions. If IRS doesn't seem to be reasonable, what is that they're going to do? They have a option to go with a residual method. So what they will do is they will put together all the assets that you have, because this is a lump sum purchase or sale, or maybe like a part of those are being sold out and all. So what they do is they'll put all the assets together, what you're buying or what you're selling, and they'll start with the most liquid asset. Okay, most liquid asset on the top. So if you're paying some $500,000 to acquire a business, and there's $100,000 in bank account, then they'll say, okay, $100,000 makes sense. Start with that. That will reduce the sale price. Then what is the next liquid asset? It could be accounts receivable. Then it could be inventory, because accounts receivable is still easy to collect rather than going out and selling the inventory. Or it could be some short-term bonds or investments and all. That is also more easy, because you can just go ahead and sell that off. Okay, so this is the order that they are saying, that we have to go in this order: cash equivalents, near cash items, such as CDs. CDs would mean FDs, fixed deposits. So they call it certificate of deposits in US. Securities and all those things, meaning stocks or some mutual funds that you put money into, or those kind of things. Then accounts receivable, then we'll say property held for sale, which could be inventory, then all other assets will come up. So the most liquid asset will be on top, The most fixed assets kind of thing will go on the bottom, which cannot be sold immediately. And the last, if there is any value left after adjusting all of those assets, if there is still anything left, that will be considered as goodwill. This will become the last, and that's why they call it, this is the residual method, because we have to see what is the ending, what is the difference that we are reaching to. What is the residue? Residual method meaning, okay, take this out, take this out, take this out, take this out, and then in the end we will see what are we left with. Okay, so that will be goodwill. We'll just go through one of this example. That will help us. And there's one more note. It may be the other way around, that we will probably not be left with any residual value. So when the purchase price is lower than the fair market value of the assets, the purchase price is lower than all the assets that we are buying, then there is no room for goodwill, right? Because as it is, we are paying lower than what the fair market value is. What is goodwill? When we give a higher amount than the fair market value. The fair market value on the books could be $100,000, but to acquire that, we'll say, okay, we'll give you $110,000. That extra 10,000 will become the goodwill, which could be an intangible, like maybe the brand equity that you have created, or the, the recognition in the market that your business has. Okay, or the respect that you have gained, and all those things. That could be all intangible items. That could all be goodwill and all. But sometimes maybe the business is not doing good, and we are actually paying less than the fair market value. In that case, what happens? Obviously, there is no goodwill. So how do we apportion the cost basis to all the different assets? Okay, so what they are saying is, when the purchase price is lower than the fair market value, the price is allocated first to the face amount of cash, then to assets listed in 2 to 6, according to their relative fair market value. We have to see, cash is cash. There's no concept of fair market value. Cash is cash. Near cash item may also be cash, but there could be some difference. When we actually go and sell the mutual funds, the NAV might have changed, but it will still be more or less in the same range. So we are going to see what are the other assets acquired, and we have to accordingly, apportion the prices to relative fair market values. This could be a bit confusing, and that's completely okay. But try to pay attention, try to see if you can follow, maybe make your notes, write it down. Sometimes it really helps when we are writing down, because if you're going through a lot of new things in one class, then it could be a bit confusing, okay, which is quite natural. But that's why these kind of examples help a lot. So we'll go through this example. This is lump sum assets, how to spread the purchase price or the sell price if the price is lower than fair market value. Okay, this example they're giving, when the purchase price is lower than fair market value, then how do we spread it into all other assets? So we will see this part through this example, and that will really make it clear for us. Okay, I really want, maybe Shweta, can you go over it? But you also need to explain it properly. So, okay, and then we'll end it over here. Maybe let me just finish up these two part quickly. If we are selling any stock, we can just see, if we know which lot we are selling, so we can properly take the basis. And if we don't know, if there are too many stocks that you have bought and you don't know which one are you selling, then go with FIFO method. What is FIFO? Ayush, do you know that?
First in, first out, ma'am.
Very good. Perfect. Any demolition cost. So when we are, let's say we're buying a building or the taxpayer is buying a building, it's too old, and they said, well, the builder is probably getting there and said, okay, I'm going to demolish all of that, make sure this is all clean, and I'm going to construct a brand new building there. So any cost as per IRC, as per the code, as per the IRS, cost and losses associated with demolishing a structure are allocated to the land. It will not be allocated to the new building that you're going to construct. This is part of the cost of the land. And land is, who can finish this sentence? Land is appreciated, depreciated, what is it? Honey?
Land is appreciated, but
Land is, yes, it is never depreciated. We don't put a depreciation on land. That's why another reason, like if you remember, whenever we are working on tax returns, if there is a Schedule E, which is for the rental expense and revenues. Schedule E, this is for the putting up all rental income, which will be rental revenues and rental expenses. We will always, whenever we have to calculate depreciation, one thing that we always want to make sure is that full amount of property should not be depreciated, because there is a component of that price which goes towards land. It is not hanging in the air, right? Or it's there, it's built on the land. So maybe that's why we always come up, if we don't have the proper price, or if we don't have the proper breakdown of that cost, if the client has not given, we will assume that maybe take 50%. Take, if the property is bought for $1 million, let's assume that 50% is toward land, 50% is towards construction. Or maybe take 40% towards land, because in US land is readily available. There's a lot of land available. It's a huge country. So the prices of land is not as high in a lot of places, because it's so much in supply. The prices is not as high, but maybe constructing a house there, or a property there, or an office there might be more expensive. So we have to take a reasonable percentage. If we don't have the data, we need to understand it from the client that, okay, when you bought that property, what did the appraiser tell you? What should be the cost of the land here, or how much in that value, how much should go towards land, how much should go towards the construction. And accordingly, we'll calculate depreciation only on the constructed value, only on the constructed cost and all. Okay, so let's go over this now. Yeah, Shweta, you can start. And with this, we will close on it.
Bennett Industries just purchased Beard Nation Inc. for $450,000. All
Okay,
of
first
the
of all,
assets
please do not use 4 lakh and 3 lakh and 2 lakh. Okay, let's just use this
$450K.
$450,000. Okay.
All of the liabilities were paid off at the date of purchase. The assets of Beard Nation are as follows: cash, $50K, marketable securities, 150K, accounts receivable, 125K, inventory, 100K, equipment, 75K, land, 50K, and the fair market value of all these assets are $550K.
Okay.
The basis of cash is the face value of $50K, which is obvious, which reduces the outstanding basis to $400K. Okay.
Can you please
Next, the
explain this? Can you please explain this sentence?
yes, ma'am. Actually, the purchase cost is $450,000. So cash value is reduced, so it comes to 400K.
Perfect. So the purchase price for 50,000 we saw here. Out of that, we are going to go in this order, right? We should have the assets
Cash.
categorized in this order. So we'll first go with the cash and cash equivalents, and we are reducing the basis. 450,000 is the purchase price, so we are reducing to 400,000. fixed cash, right? So now we will see how to assign that $400,000 to all these categories. Okay, let's go ahead
Yes.
next.
Next, the fair market value is assigned to class 2 assets. So the basis for marketable securities is 150K, which reduces the remaining basis to 250K. Okay, so again, dollar. Next, the fair market value is assigned to class 2 assets. So the basis for marketable securities is 150K, which reduces the remaining basis to $250K, like 400 minus 150. So it comes to 250. Accounts receivable are class 3 assets and are assigned the fair market value of 125K. Uh, then 250 minus 125K, it comes to remaining basis to 125K. Inventory is a class 4 asset and receives the fair market value of 100K. Then again reducing the allocable balance to $25K. The land and equipment are both class 5 assets, but the fair market value of these assets is less than the remaining basis.
What is the
Okay.
remaining
Uh,
basis here?
25K, ma'am. Remaining basis is 25K, and if we add up equipment and land value 75 and 50, this is less, 25,000 is less than
No, so
this
there, I
total
think there is
amount.
a mistake here.
Okay.
The fair market value of these assets is less than the remaining basis. How can it be less? The fair market value is this 75 plus 50, right? 125. The remaining basis is 25. So it's okay, there's probably a typo here and all, but we know that the basis is less than the fair market value. Okay? That's what we are seeing here. The purchase price is lower than, so the remaining basis is 25, but then the fair market value for this category is 125. Correct?
Yes, ma'am.
Okay, go ahead then.
And then the basis needs to be allocated between these two assets based upon their relative fair market values. Um, the equipment receives the basis of $15,000. Like we'll take a ratio of 75 and 50. 75 divided by 125, and then apportioning it like 25,000.
Correct, correct. Because the value
Yeah,
of
that's right.
equipment is 75. So we'll, and we, the total left
Yeah.
amount is 125. So we'll take
Yep.
that, but the basis is only 25. So
25.
out of that basis, we'll take this ratio. So equipment receives a basis of 15,000,
And yeah, and land receives a basis of 10,000.
remaining of 25.
Yes.
Right? So now this is what they're saying. This is class 1 asset, this is class 2, class 3, and then we are coming up to here class 5 assets.
5. Okay.
4 is inventory because this is held for resale. So this is 4. But then both equipment and land is going to be class 5 assets. Section 197 intangible. There is nothing intangible here. We're talking about still talking about equipment and land. If there was an intellectual property or if there's like technology, know-how and all, those come up as intangible assets. But these are all tangible. So both of them will fall under this point. Okay, class 5. That's why they're calling it, they're going with this name, they're calling it that both of them are falling under this. If one of them was, this asset, the other one was 197 intangible asset, then we'll not do this, the ratio calculation. What we will do is we will assign all the bases from class 5 to the remaining. If there is anything left, we will take it to 6. That's how we have been doing with the other assets. Is that clear to everybody?
Yes, ma'am.
Since both of them are class 5 assets, we have to use this method of taking their fair market value and then using the ratio and allocating the basis to these assets. So that way, all these assets will have individual basis, which will add up to $450,000 because the transaction is happening for $450,000. Okay, hope it's clear. So we'll just stop here now.